I did a video a while back looking at how I was looking at tilting my portfolio to small cap value to potentially increase returns over the long run. I'll link to that video in the description. As a quick recap, small cap value has been one of the best performing factors over history. These are smaller companies that are typically seen as trading at a lower price relative to the company's financial situation. Someone who has done a lot of work in this space is Paul Merriman. As you can see in this table from the Merriman Financial Education Foundation, it shows that $100 invested in small cap value outperformed the S&P 500 by an unbelievably huge amount. $100 grown to about $478,000 in the S&P 500 compared to $8.6 million in US small cap value from the period 1928 to 2017. Just remember, past performance is not a predictor of future performance. However, the theory presents a reason for why this small cap value premium should continue into the future: increased risk. It's been a seriously rocky ride for small cap value, with the worst one-year return of minus 55.5% and the best one-year return of 125.2%. And this is precisely the reason that these returns are potentially available, as the small cap value area comes with higher risk and some crazy volatility. But for the patient, long-term, disciplined investor, I see this as offering some serious potential to increase returns. So which fund did I end up going with? I previously discussed a few different options, but the option I went with is the SPDR MSCI USA Small Cap Value Weighted ETF, ticker symbol USSC. Any regular viewers will be aware that I always try to keep simplicity at the top of my agenda when it comes to most things in life, especially investing. From what I've read, the research has mainly focused on the small cap value factor within the US. Also, this is one of the only funds that offers exposure to small cap value for anyone investing within the UK like myself. If there was a global alternative available, I'd have probably went for that one. Comparing recent returns of this fund against the global benchmark shows it's outperformed over the last 5 years. However, it's still underperforming against the S&P 500 over this period. So who knows if this is just because it's a US-based fund as opposed to a global small cap value fund. And 5 years is not really long enough to reliably see this factor play out over different market cycles. If we look at the MSCI World Small Cap Value Index compared to the MSCI World on this fact sheet taken from the MSCI website, we can see that $100 invested in July 2008 in the MSCI Small Cap Value Index would now be worth $292.48. compared to around $300 in the MSCI World Index. It's only when you go back to May 1994 do you see outperformance of small cap value compared to the MSCI World Market Cap Weighted Index. Is this all just data mining? Maybe, who knows? One thing is for sure, you definitely have to take a super long-term view when looking at tilting a portfolio to take advantage of factors such as this. And there is the risk that this premium no longer exists and won't show up in the future. But all we have to go by, really, is the academic research which explains valid reasons why this premium exists and shows proof in the data. I believe that the best place to invest for equity exposure is in a low-cost global index fund. If you are like me and want a bit more juice, then the research has shown that getting some exposure to the small cap value factor may be the most reliable way to outperform the market over the long term. Just remember that there are long periods of underperformance when it comes to factor investing. So once you're in, you have to have the confidence and faith in the decision over the long term that the factor will come to fruition and increase your overall returns.